Welcome back to the Sunday Report. My name's Josh. Bond markets are signaling chaos as the Fed pushed the market too far. Let's talk about it. First things first, wow, what a crazy week this week was. We had some really great days. I think actually when we got our economic projections, the day of the FOMC, I think I made 22 trades in one day. We were absolutely just killing it, calling the tops and the bottoms in a very volatile market. And at the end of the week, it was like, how far is the selling really going to go as it kept going? However, I didn't catch it during the week, what was going on with the bond market. And I think something serious is at play. So even though it seems like we're retesting those lows that we saw previously, there is some base case that this could continue to sell off. So let's dive into the technicals for the market and see what signals are presenting themselves there. So last week I was saying, hey, if SPY breaks 380, and remember we had some lines set here for the range we were expecting some chop. And I said if SPY breaks 380, I'm expecting 370 to come fast. Boy, did that play out. What I didn't expect is for it to go all the way to 360 and already try and test the previous lows that we had in the market. And lots of people are saying that this is bound to go even lower. And so real quick, I actually just want to pull up a chart that we first posted back in June, where we predicted the first low at the 3,600 range or 360 range for SPY. This is SPIX, which is it's just 1,000 times more, 10 times more. And we had originally charted 3,200 as the lows for coming into September, October. Now, if we go back over to TradingView, what we didn't predict is that huge rally that we got. And this rally said, hey, likely to not see another new low come out for the year. Now, right now, we're seeing that theory tested. Now, remember, if we do break a new low, that would be the first time in history that we have a 50% retracement from a bearish sell-off and then re-achieve new lows. So that's a first in history. Now, granted, this would be the first historical thing to happen in this market. This has been a very wild year. So if we do see a break here, I would be looking at 350 for the next level of support. And if 350 doesn't hold, we might have to fall back to this chart and say, okay, maybe we do come back to those pre-COVID highs that we saw, because you have to admit the fear in this market is, if we look at the fear and greed indicator, we can see that we're in an extreme fear range. There's a lot of factors that play into that based on people's positioning, social media sentiment, all of that is priced into that. So that extreme fear showing there shows that this is even more terrified market than we saw at the previous lows. But another thing that we have to keep note of is the RSI here is really oversold. The RSI on the daily chart, on the year-long chart, tells us that this market is really oversold. And if we come down to these other graphs, we could see, hey, this market's oversold on almost every graph that you can see here. It's signaling a potential bounce coming in. And we saw the market see these indicators and try to bounce on Friday coming into the end of the day. And I am actually in some calls that I'm trying to swing into next week, because next week I do expect at least one big buy day, as we are already seeing some buyers step in. And I think that could be a really great move. Hey, if 350 is the bottom and you start your buying now, which I've actually started as well, I've heard some people say they're putting 1/3 of their cash in right now, and they're going to buying. A lot of the people in my network are, a lot of the portfolio managers or broker-dealer owners that I speak to are saying, hey, we're seeing this as a time to go ahead and deploy some cash. And I think that's good. Remember, the age-old saying is to get greedy when everyone's fearful, and to be fearful when everyone's greedy. Now, of course, in the actual execution of that age-old premise, you actually have to not also be fearful when you're buying. And I see that there's still quite a bit of fear, even from some of the people who are buying. And if we look over at the VIX, we could see that. Remember, we set these ranges and I said, hey, any big breakouts over 28, any meaningful moves here? And you can see we got some moves. This candle tried to break out. These wicks, that's not important. This candle's a red candle, a sell-off. Not important, but as soon as we got this big move, a green candle that was able to hold over that 28 level, boom, did that take off. And it had a violent reaction in the market. And even though we're trying to bounce on Friday, you could see that the fear is maintaining high. Now, if you followed in the Discord, the volatility trade, where we actually went long on volatility before we even got to this range of chop, that ended up being very profitable. And I actually have been selling into this fear into the market. And I like the move, but I'm not taking that cash and I'm actually deploying it in different stocks that I like and even buying bonds, which brings us to what's going on with the bonds. Okay, be honest with me here. When's the last time you actually planned out your spending, your finances, or planned for your retirement, or how to preserve the wealth you already have? Listen, you need to call Rob Reed. There's no one better. Learn about different investment strategies to help you create or preserve your wealth. It's for your success. You know you need to get it done. I know you've been pushing it off. But honestly, learning about index-based life insurance, which is basically like a rich man's Roth IRA and allows me to be my own bank, was huge. So if you want to learn more, call the number above or visit cwrpcg.com. This is just a friendly reminder that if you're a subscriber in the Discord, you're likely already seen these charts. And we're constantly putting up new information and data. Not all of this is actually public. Some of it is different privileges that we have or partnerships that we have or different hedge fund managers or professionals that are sharing this data with those who are members of the Discord. It's there to help you. So if you haven't already, go ahead and try a free trial so that you can also see this data in real time. So the first chart we're going to pull up here is the bond liquidity. Now, you might think that this line going up is a good thing because you're used to looking at stock charts, but this is actually not the case. This is a different data that we're looking at. This going up means an evaporation of liquidity. Remember, when liquidity starts to evaporate, volatility starts to climb as well, and then you get the chances of bigger moves exploding. And we can see here, this is during the COVID crash. We had this very unhealthy straight up and then straight down move from the bond market. And we can see that we're re-achieving those highs right now in the current market, which just shows you how scared the bond traders are. And remember, bond traders are usually correct, but this market looks broken. And if we look here at the MOVE index, this is a Bank of America volatility index. And this is showing you that the volatility in the bonds is matching that evaporation of liquidity. And it's re-achieving these COVID highs, looking like it's about to climb up and peak again. Now remember, when bonds have this amount of volatility, this volatility is greater than the actual stock market. Very bad sign. It means we could have some explosive moves here. And if the Fed could be breaking or has broken this market is a better way to say it. Now the question is, what does that mean? And it means that market participants likely think the Fed has tightened too hard on the market and is worried about the recession that even the Fed has admitted is likely to come from their economic projections. Now they maintain that they need to fight the monster that is inflation, but the market is saying otherwise. And we can see during the COVID crash what happens when the market says, hey, you're going to need a pivot. We get this huge climb up in TLT. Remember, it's an inverse relationship that bonds share with yields. As interest rates go up, the yields go up, the bonds come down. But if the Fed reverses policy, they start to cut interest rates, these yields will then come down and the bond prices will actually come up. And if you've been following me, I was wrong about bonds earlier this year, expecting that this would actually occur a little bit sooner. But the Fed's been able to tighten to this extent. And as I've said actually previously, the Fed will continue to do this until they likely break something. And we could be seeing that break, or probably are seeing that break occur right now. And so TLT and bonds look like a good buy to me. And so does a lot of these stocks. Now, I've been posting a lot of stocks in the Discord. Real quickly, we'll go ahead and talk about one that's been a big topic of discussion across the social medias. Adobe, who had a big sell-off because of a company they recently bought, which is a major competitor whose name is escaping me, and it should not be escaping me, but it is. But it was a cloud competitor because their cloud is, and their competitor was doing really well on a free-to-use basis. Their growth, which lots of people said during COVID wouldn't be sustainable, actually turned out to be really sustainable. Now, the reason for the sell-off in the stock is because people saying that they overpaid for the company, but I can't help but think Yeah, but if you're taking out your number one competitor who's had explosive growth past COVID, when people said, oh, it's just a COVID boost they got, and then they continue more and more multipliers and continuing to grow, you eliminate that competitor, you then bring on a high growth company onto your balance sheet. So now you have a high growth component in your portfolio, and you've eliminated your number one competitor pretty much. You still have like companies like Canva that are still a participant in this market. However, they don't have the same amount of saturation that Adobe has, obviously. Most people have heard of Adobe, especially if you're a content creator. Adobe, knowing how to use Adobe is a must. And now that they have this better cloud competitor that they're choosing to keep separate for now with a separate management team, the CEO there is still the CEO of that other company. However, you'll probably see those integrated over time, over a period of 3 to 5 years. I think that this could be a big win for them, even though they likely did overpay. But is it really overpaying if you're eliminating your number one competition? And so when I see the levels that the stock's at, I can't help but say, hey, this is one of the names I'm looking at for these sell-offs. And I'll quickly go over another one, which is Coinbase. Don't forget, BlackRock decided, hey, we love Coinbase. They took huge positions here. And we went through in the Discord actually and pointed out the other serious long-term buyers for Coinbase. Now remember, even if these companies want to get out, they're not going to sell for another year. They don't want those capital gains tax. So they're going to keep those positions on, even if they feel like, maybe too soon. They're going to hold this. And actually, if the Fed decides to pivot, which will go ahead and say that, if you're looking at the euro dollar, which is US dollars that are invested in foreign markets, they're actually projecting a Fed pivot early next year. It's another very important market to look at. Like bond traders, usually smarter investors are here, and usually they give really good signals if you're paying attention. So if the Fed does pivot for the crypto market, this could be seriously bullish. An easing of monetary policy means that you can do more speculation, and that could bring a lot of interest back to crypto, because that technology also helps with DXY. And if we look at DXY, I guess I should pull that up now next. If we look at DXY, look at that, 113. I said that this was likely going to head back to 115. We're already at 113. The dollar milkshake theory, I won't reiterate the whole thing over again. I don't want to get too repetitive. And we've covered a lot of stuff today. But the dollar milkshake theory could potentially lead to a currency collapse globally. We're seeing a lot of currencies already collapse globally. This is causing huge trouble with the debts that are in US dollars from other countries. Some are even defaulting. And this just makes the bullish case, the fundamental case for crypto so strong. And if you're looking for exposure to that, but you don't want to buy any crypto, you might as well go with the company who has the backing of the smartest investors that are out there. And that's Coinbase. So I can't help but really like this name, and I've been doing some buying there as well. Now, there's two things I want to recap that I kind of touch on. First would be those euro dollar markets signaling that the Fed will pivot next year. Now, the Fed has said inflation is a monster to fight, like I said earlier. But I expect some political pressure. Now, remember, the Fed's not supposed to be political, right? But the head of the Fed is appointed by the president. They're kind of inherently political, whether they want to be or not. And I expect a lot of those political pressures to come in and say, hey, I know inflation's bad, but look at what you're doing to the economy. Our voters are getting mad. We need to do some stimulus. You need to start easing. We need to fix this. And it wouldn't be hard to imagine a narrative that they construct around that, whether it's related to COVID or Russia, Ukraine, or what's going on in Europe, or even climate change. Oh, we need to do a climate change stimulus, something like that. It wouldn't be hard to imagine that plays out and we actually see a pivot maybe at the end of this year, maybe at the beginning of next year, like the euro bond market is saying, euro dollar market is saying. That wouldn't be surprising to me at all. The second thing I want to touch on is, hey, I'm starting to talk about individual companies when usually I'm just talking about macro. And that's because this type of market environment is perfect for alpha hunting. Now, alpha is the nomenclature for what you would use when you're trying to pick out names that are going to outperform the SPY, your benchmark, okay? You're looking for these big winners that are going to really outperform. Now, Alpha hunting is best when there's a bunch of market volatility and you could see some divergence rather than just everything moving together in this big macro trends, right? It's been really hard to do that in the current market environment. But I think now's a perfect time where you could say, all right, this name I'm bullish on, that name I'm bullish on. Who's a loser? That's a loser. That's now my hedge for my portfolio. I'll short them, go long here. If market crashes, they're going to be the bigger loser. And even if the market crashes, this could be a big winner. That is a stock picking market. That's actually my favorite kind of market because that's where I can get deep into research into specific companies and start talking about that more. And I'm pumped for it. That's why last week I already started doing that. And that's why this week I wanted to include some names as well. Now, of course, those are just small glimpses. If you want to be a part of the bigger discussions about other stocks or other companies, or even bring up a company you like, have me dig into it, make sure to join the Discord and join the discussions there. Now, the other thing we need to talk about, and then don't worry, I wasn't going to miss it. Let's talk about energy. Now, USO broke some pretty key level, and I'm not liking to see that. Now, however, still seeing lots of pressure for this to bounce. If we think about the fundamentals, the government, President Biden hasn't even come out and said, hey, I think I want to be a buyer. I drained our reserves to historical lows. Now I want to come in and buy these. I think I talked about this last week as well. So there's some indications that some bullishness should get back in here, especially with the supply constraints that we're seeing globally still in play. However, on bounces here, I'm likely to go ahead and de-risk slightly from these positions and look for some individual companies, which I've already started to do. If we look over at XLE as well, we're seeing some weakness here in this market, and we're kind of seeing what I was kind of hoping wouldn't happen, where this market crashes, extreme volatility, everything gets beaten down. However, it's important to note that if we really compare this to SPY, if you're in energy right now, you're looking at the people who are in stocks or individual companies, you're saying that sucks, like this sucks, but that really sucks. And I think that energy still has been a nice place to hide, trying to avoid some of this market volatility. Now, I like bonds a little bit more than energy, and I'm starting to reflect that in my portfolio, which, by the way, is now shared in the Discord. I set up a Google spreadsheet to now track all the allocations. We had an old system where I was just posting when I was buying, when I was selling stuff out of my portfolio. I think the Google spreadsheet's a little bit better. So now that's for subscribers. They have access to that Google spreadsheet. You can just go through and look through that as well. And in the future, there'll be more changes for that as well and more information. But we'll talk about that later when we get to that. But in future rallies, I will likely pull some risk out, take that money and put it to work into individual companies that I think will really succeed, or even put that money straight into crypto. I do have crypto positions. I have been a buyer in those markets. Still love the big names, Bitcoin, Ethereum. But had some back and forth about Solana. I really still like Cardano, despite this name not getting any attention. We've talked about this a lot in the past. If you're digging through the fundamentals, you're digging through the technology, it's hard to find big standouts from Bitcoin, Ethereum, and Cardano. I know Solana gets a lot of hype. However, the technology that it would take for Solana to succeed and to grow its network to hit that Metcalfe's law, which you can learn about in the Discord as well. That's free. That's a part of the free education. It needs so much time to really get there. That Solana is just still not a name that I'm super hyped about. I'm not there. I'm almost there. I'm right at the edge. But they have yet to get me really pumped about that. And now, of course, let's talk about what's upcoming this week for economic data the week ahead. And I want to repeat that this week I'm expecting a big bounce on one of these days, or maybe even a multi-day little mini bounce. To see how this really plays out, we should bounce over that double bottom and see if that wants to hold, or if we will revisit 350. Remember, that's the next level. If that sells, then we're looking for the COVID highs as the next support and potential true bottom for the market. Now, for the upcoming week, though, we have the speeches on Monday. We usually don't have much going on Monday, so the market will probably be listening to these speeches a lot, especially wanting to hear the Fed acknowledge what's going on in the currency markets and the bond market that are clearly breaking and broken. Tuesday, more speeches, durable goods, new home sales. The housing market's definitely starting to regress. And that's a big deal. That's a huge part of our GDP. These prices are still pretty high, though. Lots of people talk about the housing market is in the middle of a crash. It seems like it's very segmented in where it is, very location based to what areas the prices are actually coming down. This doesn't look like a systemic crash that is similar to '08. Although we've seen lots of comparisons to '08, especially for the stock market. However, I don't see those really playing out. There's so many things that are different from '08 and today. And that would need a whole other video. I mean, just one off the top of my head is our debt in '08 was nothing compared to the debt that we have today. And the dollar as a factor is not the same in '08 as it was today either. Remember, we're at like 250% debt to a GDP ratio. And we were barely at 100% last year, which means, there's not a lot of flexibility that we had in '08 that we have today. And that would take a whole other video to get into. We've already covered so much. So let's focus on this economic data because we're already picking up time in this video. These are supposed to be shorter. I was told to keep these around 10 minutes. I think we're already double that. Wednesday, what do we see? We see more speeches coming up. Not much big here. GDP sales, we already know Q2s. And so we're going to be wanting to see Q3 data coming in Friday. Personal spending and personal income will be the big numbers. So Friday's going to be your big day. Consumer sentiment will also be interesting to see as the market's starting to melt down. And we'll see if this fear that's reflected in the market, let's see how long it takes it to hit the economy, because it will. Remember, the market is a future-looking indicator. So if the market's doing this is likely what we're going to see play out in the economy soon as well. Definitely going to see in the economy soon. And don't forget, we haven't even hit these big famine stories that I know are just around the corner at this point. We've talked about a lot in the past. So that's what I'm coming up for the economic data points. Friday is going to be your big day. Lots of speeches. I think the market will be paying a lot of attention to these as well. Next week's going to be some more important data. This week's kind of a lull overall, except for that Friday data. That's going to be it for this Sunday report. We covered a lot of topics. It was a lot of information. I hope you found this helpful. Remember, this is to help you. This is to try and bridge that gap between, this is so technical, I don't understand it, or this is so, so much nomenclature, I don't understand it, so that the average person can really get a grasp on what the professionals are looking at, what they're paying attention to. And I hope that is the goal that's accomplished, and I hope you enjoyed this Sunday report. I think the one thing I'll add for those who watched the video all the way to the end as a thank you is the algorithms that we talked about in the past. Hey, they still look like they're very bearish right now. And so if we do see these pivotal breaks, if we do see 360 break, we'll likely see big moves like we have in the past that are really fast, and that'll be those algos wanting to sell. They still have a very bearish favored sentiment. Now, if we do get a significant rally off a double bounce, those could also play in along with retail chasing, and we could see that explode to the upside. If we do see the Fed pivot, a lot of those algorithms will immediately hop into bonds, and we'll see a huge explosion there. TLT is one of the reasons why I not only have a TLT position, but also some long calls there as well. And they've been bleeding. It sucked. Trust me, it sucked so much. But I think that the payout could be huge when that fundamental basis for those positions starts to play out. And it's been a nightmare to manage that throughout the year. But throughout the year, I've been saying, well, when it comes, it's going to hit. And luckily, other positions have been doing really well along the way. So overall, the year's playing out. We only got a few months left, still beating the benchmarks by quite a bit. Hopefully that success continues. And yeah, I got to end the video here. It's gone on way too long. Thanks for watching. Please like, subscribe. It helps a lot. And I'll see you a lot this week.